Thank you.
I mean, thanks, Nick. You've kind of stolen most of my thunder, and agree with most of what you said. I just thought from our viewpoint, or that of our members, I'd just fire quick 10 points of current note around the MiFID process. And our members are interdealer brokers, so they don't take positions, but they effectively get paid for arranging and finding liquidity in OTC and derivative markets. So that bit of MiFID, really, which is beyond the exchange-traded equity piece, is interesting to us, and that's the bit really where MiFID 2 goes into beyond MiFID 1, be it fixed income derivatives, commodities, FX, carbon and metals, etc., etc. So, yes, I agree. MiFID is in general trying to do too many things for too many people in different ways, and is failing under its own weight to try and do it all. Our angle is not the investor protection angle. We deal in wholesale markets, so we're very much focused on the structure, the market structure, and the platforms angle. And whilst I don't want to be too critical of MiFID, our main point has always been very supportive, which is the OTF category. We've been its main champions. We sat down with CSER in the first place and the various national regulators to come up with it, championed it on to Commission, who took it on and put it into their proposals, and have tried to nurse it through the dual council and parliamentary process, which is we thought it would be welcomed with open arms, and it really hasn't been. It's been treated with a lot of scepticism, the old OTF, and effectively what it is representing the change of business of our members from acting as agent in the OTC markets and introducing brokers to becoming venues. And OTFs, a little bit like MTFs, are now these venues for things that don't trade with a liquid, deep order book that can be accessed because it's a benchmark product with lots and lots of retail-y participants with lots and lots and lots of small orders above and below the bid and offer size. But actually wholesale markets, even the basic FX markets really, all the way through, do not trade very frequently. They tend not to. They tend to trade in large size where liquidity and blocks need to be searched out. They're traded by participants who are located all around the world and therefore don't easily suit a national equity order book type regulation. Nevertheless, that was the sort of regulation that MiFID 1 was rewritten as MiFID 2 or MiFIR and threw at us. So our business has been trying to adapt that to work from our end. What do we, what do we think of that? Well, we've come up with the OTF to accommodate it. We think our members are happy to change the nature of their business to become venues and all the rights and responsibilities of organising markets, of basically becoming regulators to their own markets and transparency agents to the reporting side of the post trade. We do have a note that it's intrinsically trying to put a global market into a regional infrastructure. So one is we think OTFs solve a problem and they need to be embraced, and they probably haven't been the way they should be to date, at least only by Commission. Secondly is scope. A lot of disagreement in the legislative process between the bits of Parliament or the Member States or even the bits of Commission. Is it just derivatives? Is it derivatives and cash? Is it FX? Is it commodities? Is it physically delivered? Is it retail? Is it wholesale? What do payment systems sit in this? Is FX a payment system, which was treated by the UK as a MiFID 1 or an investment? Lots and lots of issues. Standardized product versus non-standard. Are we going to create a wrapper for standardized derivatives into OTS and a different wrapper for more standardized clearing issues? How does all that fit together? Quite a difficult one there, and I think our answer is let's leave a little wider scope at the beginning, and it can narrow down as markets evolve, because the role of capital, the role of technology are changing so much that the world will not look the same in 5 years' time. And so let's have an open wrapper, let's get everything inside of regulation, let's get everything reported, and then it can close down. It doesn't need to be a bun fight, as we've witnessed for the last year or 2 years, if you include Commission, as to the minutiae of the details. And to that end, the Commission put out a paper on post-trade transparency on fixed income markets a month or so ago, to much consternation that it ever got leaked out, and I think many hands got wrapped and everybody was told to say it never existed, which had an idea of let's have a 2-year wider window of 2-week reporting and then look to bring it in as appropriate. And that's appropriateness, suitability, and issues that really should underpin this move, because it's quite a major change. Point 3 for me, and I'll just run through this a bit faster now. Point 3 is transparency. And really our angle there is get the proportionally right to transparency. Who needs transparency for what purpose and when? Is it transparency to regulators? Is it systemic risk? Is it allowing consumers or retail to find out where markets are? Pre-trade transparency, we were given a wrapper from cash equity markets, which really didn't work for wholesale markets where there is no latency of price. The business sits inside of the balance sheet of the financial institutions, the banks or the funds or the energy companies or the utilities, and they tend to give out prices and take them as they need them. They don't have this latent set of prices. So pre-trade transparency doesn't exist in the same way, and we've been fighting for some sort of indicative transparency where you can indicate where markets are. And Commission took that on quite well, but it's been really a fight in terms of both Parliament and Council to get them to embrace the way the markets work. Price and size are very different in wholesale markets. Again, if the equity markets are perhaps 40% OTC, perhaps not, the bond markets and the derivatives markets are probably 99% OTC. So taking an equity wrapper and trying to give it to this 99%, which is also, whatever it is, 10, 100 times the size in notional size, is a strange way to start regulation. And price and size are very different in OTC markets. Often you'll build a price in the middle of the bid offer. Often a wholesale participant will want a price which is outside of the bid offer, and you don't have the same idea of best execution in wholesale markets that built up in an equity market, and the idea of building a trade is somewhat different. Post-trade, again, we've been doing a lot of work with AFME in terms of calibration and suitability of what you say when after a trade, so that you don't disadvantage the winner of the price. This feeds back from, as Nick mentioned, about the impact of Trace in the US, which absolutely killed the fixed income market stone dead in the water in the US, moved the entire corporate liquidity into the CDS market, with the inherent issues that then happened in the CDS market for the incumbent years in this period post-2002, post-2003 in the US. It needs just a proportionality in its approach, and you might want to start with a wide approach when you start the legislation and have an idea of bringing it in slowly, rather than this, let's get it, idea that we can get it right first time, even though technology and market structure is evolving all the time. Next point for us is waivers. A massive fight going on around waivers. Let's have fewer of them, let's have more of them. There's all the market participants saying, yes, but I need a waiver for this, I need a waiver for cash products, I need a waiver if I'm an insurance company, I need a waiver for larger scale, or I need a waiver for non-equity, etc., etc. And again, our angle there is you're trying to regulate a market which is different to the cash equity market. You shouldn't let it exist just by virtue of waivers. You should set up a suitable framework for it to live and breathe, and supervise it and regulate it as it is, rather than by dint of not being a cash equity market. But again, several years into MiFID, and that's still something we're shouting loudly and don't get terribly heard about. Overall, you see, we would argue that there still needs to be a comply and explain methodology behind regulation, which i.e. is more supervision. That if things don't fit in to the way that the rules are drawn up, then please just go to your regulatory supervisor, explain why it's different, and ask them to give you permissions to do it. Point 5 is this idea of fragmentation. It's a very political word that's heard a lot. And perhaps we say, well, fragmentation is the flip side of competition. The single market process, a lot of the European process is about having more competition. MiFID is turning into an issue of embodying the silos with less competition in the name of cutting out fragmentation, and the people who are doing this are the people who run the silos. And I think a lot of the outcomes of MiFID 2, MiFIR, is higher prices for consumers, and it's an anti-competition type mandate. And it's very strange to see Europe going down roads which are probably 180 degrees from the ethos that dominated Europe pre-2007. We've been fighting very hard for access into the silos. Once you have critical mass in a financial market infrastructure, be that a CSD, a CCP, a reporting system, or a a middleware that transfers trades from venues into post-trade. You need access into those silos and open up access. And yet there is very little in MiFID and EMIR that opens up access in the way that they promised us. In fact, we see petition after petition to say, let this only apply to off-market derivatives, let the exchange markets be preserved, let this market be preserved, let's not get in there. And again, we think opening access, allowing portability for consumers are the two key things to allow competition. Once you allow competition, you get self-regulation. Businesses don't get too big to fail. You don't have to have this whole resolution architecture of big businesses to fail. And the market starts to do the job of regulators for it all the time, day and night, day and night. Why wouldn't Europe want to do that? Instead of that, it's been going in the opposite direction, and it's a bit of a bugbear that we have.